So the IRS just released their 2025 updates to 401k limits, IRA limits, HSA limits, and related accounts, which will impact millions of taxpayers. In 2025, there will be higher contribution limits, which also means larger tax benefits. There's also going to be more flexibility as it relates to taking money out of your accounts penalty-free, and also new ways that you will be able to use your employer match if you have one. Plus, there will be new income limits in 2025, which will also impact which of these accounts or tax benefits you may actually qualify for. So as a licensed CPA that helps people with these types of things to save on taxes every day at mycpacoach.com, I want to provide you with a very simple and easy understanding of these new updates in 2025, and more importantly, how you could benefit from them. Okay, so these tax changes will take effect in 2025 and apply to the tax return you file in 2026. And to set the stage here, if you do not know much about these types of accounts to begin with, what you need to first understand is that the government basically rewards taxpayers for saving money through these types of accounts with tax benefits. And these tax benefits come to you in one or two different ways, which is either A, deferring tax to the future, or in other words, we are pushing income off of your 2025 tax return to where you would pay tax at some point in the future, which you can do by putting money into a traditional IRA, traditional 401k, or HSA. Or you could do B, which is pay tax now and no tax in the future, which means you would pay tax on your 2025 income, but will pay no tax on your investments in the future, which would apply to money you put into a Roth IRA, Roth 401k, or 529 college savings plan, for example. Now, the decision to pay tax now or defer tax to the future usually should take your current tax bracket into consideration. For example, someone in a 35% tax bracket or higher may benefit more from deferring tax to the future if they believe they will be in a lower tax bracket when they retire. Whereas on the other hand, someone in a lower tax bracket today may choose to pay tax now and earn tax-free income when they retire if they believe they will be in a higher tax bracket at that point. With that said, how much you can actually put into these types of accounts, how much you can deduct, and the amount of income you need in order to qualify for these accounts change every year. So let's go over the new updates for 2025, starting with 401k plans, since over 60 million Americans use these types of plans. Okay, so a 401k is an employer-sponsored retirement account that has two components to it. Number one, an employee contribution, which allows the employee to contribute a portion of their salary into it. And number two, an employer portion, which allows the employer to match a certain amount into the account. Now, there are new limits to both of these components in 2025. So let's address the 2025 employee 401k limits, which vary based on age. So in 2025, employees under 50 years of age can put up to $23,500 of their wages into their 401k, whereas employees over the age of 50 can put up to $31,000 of their wages into their 401k. Plus, there is a new provision under the Secure 2.0 Act that allows employees between the ages of 60 and 63 to put up to $34,750 towards their 401k. And that's just the employee side. There's also the employer side, which could add another $46,000 or so to your retirement account in 2025, depending on how they design their plan. Now, usually employers match a percentage of what you put towards your 401k up to a limit based on your salary. But what if paying your student loans or saving for emergencies is more important than saving for retirement? Well, thanks to the Secure 2.0 Act, employers can now match a percentage of what you pay towards your student loans and emergency savings accounts and they can add that amount to your retirement plan. Now, in addition to this, this act allows you to withdraw money penalty-free for a variety of instances. For example, you can withdraw up to $1,000 per year for emergency personal and family needs, which have to be repaid within 3 years. You can also withdraw up to $22,000 from your retirement plan for a federally declared disaster, like a hurricane, for example, which we have seen. And they allow you to take an indefinite amount from your retirement plan if you are diagnosed with a terminal illness. Now, these provisions ultimately add more flexibility for people who use these types of accounts and comfort in knowing that they can pull from their retirement accounts in certain urgent situations. Now, for my self-employed individuals watching this, you are also going to benefit from both sides of this equation, the employee limits and the employer limits, because you're self-employed. For example, in 2025, self-employed individuals will be able to put up to $70,000 into their 401k, plus another $7,500 if they are over the age of 50, or $11,000 if they are again between the ages of 60 and 63. Now, these higher limits simply reflect the employee limits plus the employer limits that we just saw. And we often see self-employed individuals with no employees set up what is called solo 401ks to utilize both of these limits. For instance, they can set an employer match to equal 25% of their income to get the most money into their 401k account. For example, a self-employed 45-year-old who earns $100,000 in income would be able to put up to $23,000 of his wages into a 401k as an employee, plus another $25,000 as an employer, making his total retirement contribution for the year equal $48,000. And that is just an example. There are many ways to design self-employed retirement plans and various options available like SEP IRAs, pension plans, cash balance plans, and more. So if you want to learn more about that, just drop a comment below. But let's switch gears here and talk about IRAs, which over 50 million Americans use. And in some cases, taxpayers can use both an IRA and their 401k together to get the most tax benefits. So an IRA stands for Individual Retirement Account, and it is very similar to a 401k with a few exceptions. Number one, unlike 401k plans, an IRA does not require you to have an employer or business to sponsor it. Almost any individual can set up their own IRA as long as they have some form of earned income. And most of the time they can set it up for free. For example, financial institutions like Vanguard, Fidelity, and so on allows individuals to set up an IRA at no additional cost. The second big exception is the fact that IRAs have different contribution limits than 401ks. Specifically, in 2025, IRA limits are set to $7,000 for individuals under the age of 50, and individuals over the age of 50 can put up to $8,000 towards their IRA account for the year. Now, these are the same IRA limits that we had in 2024, which means that the IRS did not increase these limits for 2025. But they did increase the income requirements for IRA deductions and for Roth eligibility, which is the third big difference from 401ks. IRAs have additional income requirements. So let's start with the traditional IRA. Usually, when you put money into your traditional IRA, you receive a dollar-for-dollar deduction up to the contribution limit. However, if you or your spouse is covered by a retirement plan at work, then you can use this deduction altogether if your income is too high. As of 2025, single taxpayers covered by a plan at work and have incomes over $79,000 will only receive a partial deduction for their IRA that phases out completely once their income exceeds $89,000. Or in other words, they will receive no tax deduction once their income exceeds $89,000. And married taxpayers, where both individuals are covered by plans at work and have incomes over $126,000, will receive a partial deduction. and will receive no deduction once their income exceeds $146,000. And in situations where someone is married and only one of the two individuals are covered by a workplace plan, then their traditional deduction will phase out at $236,000 and will be completely disallowed once their income exceeds $246,000. But remember, these limitations only apply when the taxpayer is covered by a workplace retirement plan, such as a 401k, for example. If they are not, then they can take the maximum amount as a traditional IRA deduction according to the tax code. But these rules work a little differently when you are using a Roth IRA as opposed to a traditional IRA. Specifically, you can only use a Roth IRA when your income is below a certain threshold. It does not matter if you have a workplace retirement plan or not. If you earn too much income, you will not qualify for Roth tax benefits in that year unless you do what is called a backdoor Roth conversion or mega backdoor Roth, which we have videos on this channel about if you want to learn more. But specifically as it relates to 2025, single taxpayers who earn over $150,000 will only qualify for partial Roth contributions, which will be completely disallowed once their income exceeds $165,000. And married taxpayers who earn over $236,000 will qualify for partial Roth contributions, but once their income exceeds $246,000, Roth contributions will be completely disallowed for them as well. Now remember, these limits for Roth IRAs apply whether you have a workplace retirement plan like a 401k or not. So just be mindful of this when funding these types of accounts because we see a lot of mistakes here. So those are the new 2025 limits for IRA contributions, but there is still one other big tax advantage account that we need to address: HSAs. So an HSA stands for Health Savings Account, and it is the only type of account that allows you to put money into it and receive a tax deduction. Invest in those investments, earnings grow tax-free, and it allows you to withdraw money tax-free when you use it correctly for qualified health expenses. Now, to qualify for an HSA, you must have a high deductible health insurance plan, which the IRS defines as an annual deductible of at least $1,650 for self-only coverage and $3,300 for family coverage as of 2025. And if you qualify, the IRS has increased the HSA contribution limit to $4,300 for individuals with self-coverage and about $8,500 for individuals with family coverage. Plus, taxpayers over the age of 55 can add an additional $1,000 to their HSA as a catch-up contribution. Now, most people expect to have health expenses at some point in their life, and using an HSA will just allow you to save for these types of expenses while reducing your taxes at the same time. And that's really the premise behind using any of these accounts, really, to gain tax benefits for saving for expenses that we expect to have anyway. For instance, if you know you are going to retire one day and will need money at that time, why not get a tax benefit for putting money aside for it right now? Or if you know you're going to have health expenses in the near future or at some point, why not put some money aside now for it and pay a little less tax on your income along the way? Let me know what you think about this in the comments below, and if you currently pay a lot of taxes and want a game plan that is guaranteed to reduce it, just apply to work with one of my CPAs today at mycpacoach.com.